Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, September 9th, and this is the weekly market update. A disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a financial advisor. I cannot give you personalized investment advice. Please do your own due diligence on any ideas that you hear. It's your money, it's your responsibility. Okay, this week's slide deck. It's a tweet by somebody that I follow on Twitter. Some people like this guy, some people don't. I've heard some interviews with him. I think he has some pretty good insights. But anyways, he juxtaposes a couple of headlines, one from September 2023, a Bloomberg headline, and one from September 7th, a Reuters headline. And I'll read the Bloomberg headline from September 2023. Fed officials are increasingly optimistic they can quash inflation without causing serious economic pain. So that's the recent headline on Bloomberg. And then the headline from September 2007, right before the great financial crisis really started getting in full effect. U.S. inflation pressures are easing and the economy should manage a soft landing, the Dallas Fed says. I said, so the point of this, bringing this to your attention is that no one really knows the future, and these soft landings that everybody keeps talking about are not that common. Okay, when you're using a blunt instrument that the Fed is using, which is just raising the Fed funds rate, using interest rate increases to slow the economy, you don't know. It's like just chopping a leg off, right? Instead of doing precise surgery, you don't know exactly. It's such a blunt instrument, you don't know how it's going to affect all these different components of the economy. And so typically, it presumes that this brain trust of pointy shoes at the Fed are so smart, they know how to move the levers, adjust the dials, and push the buttons in the right sequence to get a soft landing. It's nothing but central planning, and central planning doesn't work. They have this one blunt instrument. Well, they have other tools, but their main blunt instrument. And so they raise rates until something breaks, and then they will cut rates and reliquefy the system after whatever breaks. So, my overall view is the same as it's always been. This is the United States economy is a leveraged economy, debt-based consumer economy, levered up. I think 10 plus years of zero or close to zero interest rates enabled a lot of nonsensical things to happen. Allowed the federal government to do things, state government overall to do things that it probably shouldn't have done. A whole bunch of speculation that's occurred, a whole bunch of dumb businesses that should have never come into being. And now that's reversed. And we're, like I said before, there's this lag effect that's taking place, and it's slowly but surely working its way through the economy. Yes, there's economic data that's still positive, and we do have like a bifurcated economy currently. I mean, the service sector is doing very well, just as also demonstrated by the recent ISM service report, where it's actually increasing, juxtaposed against a manufacturing sector that's in recession. So, and probably a housing sector also. So I just want to point this out to you that when you hear these things about the soft landing, it's kind of like a Loch Ness monster sighting. It's alleged that it exists, but not very many people have actually seen it. Here's a tweet by Liz Ann Saunders I thought was interesting. It says, housing affordability index for first-time home buyers has fallen to the worst on record. So take that as you will. High prices coupled with very high interest rates makes it very difficult for first-time home buyers to get into a home. This is not a positive thing for the economy. One of two things needs to happen, or probably both. Rates need to come down significantly and housing prices need to come down significantly. I suggest that housing prices will probably start coming down. And then eventually, once something does break in the economy and the Fed starts its next rate cutting cycle, that will allow interest rates to decrease, and this should improve, but we will see. So I've shown this before. This has come up before. This is like an updated chart that I saw on Twitter, or maybe Jesse Felder put it up on his weekly email blast that he sends out. Delinquencies by type of debt. You have consumer loans, credit cards, and auto loans. They're all moving higher, which is what you would expect to see in a period where rates have been significantly increased. The ability to the minimum payment society breaks with rates where they're at, and that's the majority of consumers in the U.S. People don't pay cash for things. We've talked about this before. Most people don't have $1,000 in a bank account for emergencies. So how are they going to buy anything, capital good, unless it's on payments? And this is what we're seeing. We're also seeing the effects of inflation. They're cumulative, right? Prices go up over the last few years, 15, 20%. They don't come back down. Okay, so you've reset prices higher, but people's wages haven't kept pace, or their ability to pay hasn't kept pace. And so they increasingly start trying to maintain their living standard using credit cards or consumer debt. And now people are starting to default. It's very hard for people, once they become accustomed to certain things, they don't want to give them up. This is human nature. It's not prudent. It's not what I would counsel, but this is how quite a few people live. And we're seeing now, you see back in 2008 what happened with the delinquencies. We're getting up into the range of, these are not positive trends. Let's just say that. So I wanted to point this out. This was a headline. Peter Atwater had a tweet, had this headline. It says, rising yields fatten American wallets. Higher yields on everything from treasuries to money market funds are delivering a windfall to savers. So it's always the rich get richer and the poor get poorer. Again, most people in this country don't have any savings, okay, or a large majority of them. This is why I've counseled people, like what Charlie Munger said. You got to get that grub stake together. Otherwise, you can't be in the game, and you have to be in the game. Okay. The John Bogle, $288 a payday, put away for 40 years in a Vanguard low fee mutual fund, and then retire and you're fine. That's probably over with going forward. We're going to have a lot of volatility, a lot of uncertainty. You're going to have to be an active manager. That means you have to have some capital. If you don't have capital and you can't make any moves and you can't take advantage of these type situations, how are you going to make it? Because wages are not, we are bifurcating into this groupings of people that have wealth and people that don't. And people want to make fun of live a minimalist lifestyle until you can get a grub stake together. I say get 2 or 3 jobs, get a side hustle, whatever you got to do, get something going so you can put capital together, because you got to be in the game, and you got to have, $1,000 in an Ameritrade account ain't going to cut it. You need several $100,000. You got to do whatever you got to do to get that within legal and moral constraints, obviously. Because if you don't, you're not going to be, things likely get more volatile and get more difficult as we go forward. And if opportunities will present themselves, and if you don't have any capital, you're not going to be able to take advantage. You're not going to be able to stay ahead of the game. We talk about, you get over 5% just buying T-bills, okay, or in a money market fund. But if you don't have any savings, you're not going to get anything. And most people don't have quite a few people don't have any savings. So I wanted to talk about this. We had the World Nuclear Association big powwow last week in London. I believe it was in London. we're now just now starting to see trickles of information come out. From my understanding and from what I'm seeing in my curated Twitter feed, is very positive, very bullish. Sentiment is really starting to turn. There's a lot of big money there, I think, paying attention to what's going on. And so we had a Reuters article that came out. They finally, the media is finally waking up to nuclear power and this uranium deficit. And so this is from Reuters. Basically, uranium demand to jump 28% by 2030. This is nothing that most of us don't already know, but I just want to point it out because the mainstream media now is getting this. This is what we need to get that interest, those juices flowing, right? And to get money flow into the sector. Demand for uranium in nuclear reactors is expected to climb by 28% by 2030 and nearly double by 2040 as governments ramp up nuclear power capacity to meet net zero carbon targets, the World Nuclear Association said in a report on Thursday. Quote, from the beginning of the next decade, planned mines and prospective mines, in addition to increasing quantities of unspecified supply, will need to be brought into production, unquote. Nuclear capacity is expected to rise by 14% by 2030 and surge by 76% to 686 gigawatts by 2040, the report said. So again, folks, you know the thesis. If you've been listening to me for a while, you know I don't talk about it much. We have, even in the last year, a big change in the zeitgeist where this is a growing industry now, nuclear power, okay? I can remember 18 months, 2 years ago, it was dead. Why are you doing it? Nuclear power, nuclear waste, weapons proliferation, all the canards. Now everything is turning, okay? We've highlighted many times in the weekly videos, government after government now endorsing and moving forward with plans for nuclear power. Yes, there's some people that are, out of phase. Germany, for example, but as I've said before, I predict before it's all said and done, Germany will go back to nuclear power also. But supply of uranium is not there. Okay, we have demand that's growing, but we don't have supply that's assured. And so I believe that price will fix this. I believe that supply and demand does work. Economics 101 does work, and the price will rise sufficiently to incentivize people to increase the production of uranium. So it will be necessary to fuel this growth in reactor requirements. The problem is you can't just snap your finger or hire some people on Fiverr to code up some uranium. It's very difficult to get mines built, permitted. We've went over this before. And so there's going to be that lag. There's going to be that time frame where, oh, crap, we need this supply of uranium. We don't have it. And then the price goes up sufficiently to really create extraordinary profits in the sector to pull in a lot of capital and solve the problem. And that's not going to be fixed in 3 months, 6 months, or a year. That's going to be a multi-year situation, and that's your opportunity. As we've said before, we knew this was going to happen. We've been talking about it for years. It's happening. It's been happening. I don't know what else to say. If you don't want to do the research, you can buy. There's several ETFs now just for junior explorers and development companies, or URNM, for example, or you can do the research and try to sniff out opportunities in individual stocks, or you can just buy the physical material via the Sprott Trust. So there's multiple vectors for you to take advantage, but I suggest that this is going to be I'll just say this right now, where this is going is going to make a lot of people's careers. Okay, people are going to become, very life-changing wealth has already been created for many people and will continue to be. That's how extraordinary I think that this opportunity is. And like I said, we're starting to see now more and more of the bandwagon starting to get filled up. And that's positive to get us to the blow-off stages of this thing that we need so we can really cash out. Here's some more positive news. We talk about Niger and the coup that went on there and how it's a big uranium producing district, in particular for the French nuclear industry. Here's an article from Bloomberg. Orano, it's a big French nuclear fuel producer, halts uranium treatment in Niger amid sanctions on junta. French nuclear group Orano is halting the processing of uranium ore at one of its facilities in Niger because international sanctions against the military junta are hampering logistics. The crisis that's affecting the African nation, which has about 5% of the world's uranium, may potentially tighten supplies of the material used to fuel nuclear reactors in the US, China, and Europe. That may force utilities to become more dependent on other producers, such as Kazakhstan, Canada, and Australia. Basically, there's because of the coup, there's sanctions on the country. You can't import the necessary reagents that you need for the processing. That's what's going on. I think I saw an announcement where Orano is going to take advantage of this downtime to just go ahead and accelerate their turnaround that they need to do on their plant and equipment. So I don't know about the long term, but again, you put this in the context of an already constrained supply. The recent announcements from Cameco about the issues they're having at Cigar Lake. I don't see announcements left and right. Every day I see an announcement of new nuclear reactors. There's probably 36 companies trying to develop small modular reactor technologies. I see country after country announcing more reactors. I don't see any new mines being announced. And again, this is like, it doesn't really need to really deep dive this. It's pretty obvious what's happening. And if you look at the price, we're in a bull market, and we've been in a bull market. This type of news helps exacerbate the moves, or it can. So consequently, John Quakes, please follow him on Twitter. This guy is like, I don't know, the CNN of uranium. Every piece of news, nugget of news that comes out with uranium or nuclear, the guy catalogs it. So you're never going to be behind on the news flow because John Quakes is always going to have an update. I guarantee it. So I would definitely follow him. But anyway, spot uranium spiked up through $62 today to hit a new 17-month high, with nuclear fuel brokers uranium markets up 63 cents to $62.13 a pound, with Numerico up 75 cents to $62, while fuel buyers and sellers at Evo markets didn't get the memo, closing unchanged. So again, we're moving higher. My understanding, there was a lot of people at WNA that have been sniffing around this, and I think even Sprott adjusted some things with the uranium trust to make it more easy for institutions to invest in it with some of the things that people were concerned about. So I think I don't know what else to say. I'm not going to just keep beating a dead horse. It is what it is. And I think it's, again, represents one of the best opportunities out there, along with the offshore oil drilling industry. Speaking of the offshore oil industry, this is another guy I would follow. This guy's really on top of. We highlighted the report that he did and some interviews he's been on talking about the offshore drillers and the offshore oil industry in general. I would follow this guy. I like this comment here that talks about the CEO of Seadrill in reference to new builds. Obviously what short-circuited previous upcycles in offshore drilling was the fact that because economics works and supply and demand works, in previous cycles, as demand increased, day rates for rigs would increase, and that would create extraordinary cash flow and profits for the companies. And then what they would do is what a lot of people do in these cyclical businesses. They would go out and build more rigs. More rigs would come online, day rates would go down, the industry would go into a recession or a depression, rinse and repeat. The view now is, the consensus is because of the big depression that we did have in the last 3 to 5 years, washed out a lot of companies. A lot of rigs, older rigs have been scrapped or cold stacked, and they'll never come back online. We've atrophied the industry sufficiently where now demand is well above supply and moving higher, and day rates are now, have been moving higher and will continue to move higher. And so the fear is, or the discussion is, well, they're just going to do what they always do. They're just going to go out and build more rigs. But if you listen to the managements, no one's talking about doing that. And they talk about, even if you wanted to do it, the difficulty around doing it. And so here's a quote from Seadrill CEO on new builds. And this guy's pretty entertaining. That's the CEO. He speaks very frankly and bluntly. And I enjoy, he's kind of somebody I enjoy listening to. But this is what he said about new builds. It says, every time I try to speak to a shipyard, they hang up on me. This is a distraction and abstraction. No one knows what it costs. He's talking about what it would cost to build a rig, and no one is going to build one. Maybe $1 billion in 3 to 4 years to build one. Then he goes on to say, we have a baseball bat at the office, and we use it to hit people if they say new build. We need $1 million a day or $1.2 million a day rates on a terminal just to justify one. Did you hear that? In order to even consider building a new rig, they need to see day rates at $1 million a day plus. And we're at like in the 400,000s, bumping up against 500,000. If you go back and look at the inflation adjusted peaks in the last high point of the last cycle, which was 2014, I think day rates touched the low 600,000s, high 500,000. So if you inflation adjust those, what are you talking about now? And I think we will break the all-time records, because I believe that with shale peaking, the growth in oil production and new reserves is going to have to come from offshore. Again, it's not like we don't know that there's a lot of reserves offshore. There are, and they know where a lot of them are already. But there was a reticence or a lack of will to exploit them, because with shale and the volatility that shale was causing, the shale revolution over the last 10 years, people were reluctant to go out and spend $5 billion to develop an offshore field and not be sure about what the oil price was going to be or the demand situation after that thing came online 5 to 7 years after you made a final investment decision. So now that's kind of reversed. Shale's peaking. Drill baby drill's over with. A lot more conservative. And so a lot of the major oil companies and people that do have the wherewithal and financial ability to drill offshore realize that it's now a better deal, and that's why they're moving forward. However, the industry that drills, that supplies material, it's not sufficiently large enough now to support the incoming funds, and so that's why we're in a bull market. That's why we're in the salad days for the offshore drilling industry. So great comment here. This is what we've been thinking also for a while. Again, we've talked about it. A lot of times, unless you come with like a lot of money down, nobody's going to build you. A shipyard's not going to do this. They got burned on a lot of these drill ships because people just put minimum amounts of money down, and then the industry turned down and they were left holding the bag. What bank is going to finance one of these things with all of this ESG? I mean, even though I think we're at peak ESG, a lot of these banks, you've got the IMF and the Bank of International Settlements and the U.S. Treasury trying to introduce and force banks these ESG constraints on lending. And so this is probably going to have to come out of cash flow or foreign financing from like the Saudis or UAE or something like that. So it's going to be a while before we see new equipment even be ordered, and then how long it would take to build. Like he says here, 3 to 4 years to build one. And so that's your window of opportunity, right? When you start seeing announcements to build new rigs, then you've still got a few years before, they come online. It's just supply and demand. And if you look at previous cycles, I don't think we're going to see a repeat of what we saw in the past, just because of the things that I mentioned. Again, why I like offshore oil drilling and the support companies around it. So oil prices have Brent's over 90. The Saudis extended their cuts for 3 months. I think people were thinking one more month, but they came back with 3 months. And so with inventories now shrinking and we're seeing, pretty decent draws every week in the reports, obviously that's forcing the price of oil up. So we'll see if that continues. Again, the sweet spot for me is, 80 to 90, $100, $80 to $100 a barrel. If oil stays in that, our portfolio companies make a ton of money. So people really still don't realize the deals you can get with a lot of the companies, especially in Canada. Many of these companies have long life reserves, especially oil sand type plays. They've paid down tremendous amounts of debt. We have one company in the portfolio has a very structured and well thought out return of capital program that's based on debt repayment to shareholders. They've continued to hit their targets, and the cash is now, pouring into to shareholders to the point that when debt is lowered to a certain point, which I anticipate early next year, 100% of cash flow will be returning to free cash flow. That is to after maintenance capital and things like that to shareholders. So I still think there's tremendous opportunity, and no one can predict exactly where the oil price is going to go, but as long as you have OPEC now seeming to have more control of the oil market than they had in the past, they are definitely incentivized, especially Saudi Arabia, to have oil prices be up where they are now instead of at a lower level, just because of the transformation that the Saudis are trying to do in Saudi Arabia. Basically 500 billion to $1 trillion investments as they're trying to do to transform their economy. So from the article, it says, Saudi Arabia's oil minister often talks up the virtues of surprising the market, warning short sellers that they risk a, quote, ouching, as he likes to put it. The market was caught off guard yesterday. Traders expected the Saudis to extend its unilateral 1 million barrel a day output cut by a month into October, but Riyadh announced a 3-month rollover instead. Oil popped above 90 in London for the first time since November. The move was coordinated with Russia, which promised to extend its own 300,000 barrel a day export reduction for the same length of time. While the market can be certain Saudi Arabia will make good on its promises, there will be skepticism about the Kremlin's commitment. Well, we'll see. So far, so good. I put a chart up here that was on Twitter. It's from Bison Interest, Josh Young's shop. This is basically U.S. weekly ending crude inventories, including the SPR. I know a lot of people don't like this chart, but I just wanted to show this visual because it's so striking of the inventory situation. We're back at levels that are around 1985. And of course, demand is quite a bit higher than it was in 1985. So, we're going to continue to see draws, I think, going forward, at least into the winter months, and we'll see what happens after that. We'll see if the Saudis maintain these cuts, but I suspect that oil prices will continue to be creeping higher. And what happens, it's not a 0% chance that we could have some kind of shock, right? We're in a very volatile world now. Tectonic plates are moving under us geopolitically. And who's to say that, something couldn't kick off in the Middle East or anywhere, or things ramp up with Russia and NATO. Anything can happen. You can assign probabilities, maybe not that high, but definitely not zero. And in a situation like this, we're certainly not prepared for a situation like that. As Jim Poplava said many years ago on the Financial Sense News Hour, he said that oil would be the new Fed funds rate, and the price of oil would dictate, the economic activity in the developed world. I don't think that you can discount that statement. Eric Townsend, who does Macro Voices, he has a view, and I don't necessarily disagree with that even when the economy increases, will we have sufficient oil production capability to facilitate the economic growth that will likely come from a upswing. Does the world have the ability to increase and maintain oil production sufficient to facilitate economic growth? We shall see. And I wanted to point this out. This was from 314 Research off Twitter. It says, energy versus the S&P, hard versus soft landings. Energy outperforms in hard landings and underperforms in soft landings. We'll see what happens. This is what happens at the start of the recession. But I suspect we're going to have a hard landing. That's kind of my view. Like I said, something's going to break here. We haven't seen the commercial real estate situation blow up yet. We haven't seen things blow up in high yield debt yet. The government itself cannot sustain itself at these high rate levels, or maybe even going higher, because as they roll their debt, and they have to roll like a third of their debt in the next year or so, the interest payments are going to be tremendous. So a lot of headwinds. Things are holding in right now, I have to admit. Like I said, the service sector was actually up. The PMI, employment's hanging in there. Although there's starting to be cracks around the edges. We'll just have to continue to see how it plays out. Again, with the economy, the way it's set up and how it's been financialized, I don't think it can maintain itself with these rates where there are. There are many people smarter than I, though, that have maintained that it can. We'll just have to wait and see. Wanted to point this out. They had a auction for renewables, offshore wind in the UK. I think they had one recently in the US too that didn't get any bids. I've reported on the problems with the high cost of offshore wind, and of course, like Ørsted and some of these other companies have went and complained that they're not going to be able to move forward with these projects because they don't work, at the current, price per megawatt level. And so I would suggest you to be on the lookout for another government bailout of wind, because, a lot of these current governments, even if they call themselves conservative governments, like in the UK, are all in on the energy transition, and they've bet it all on wind and solar, and it ain't working. Again, when politics meets physics, physics wins. And so there's a lot invested. There's a large constituency. There's a big lobbying effort, and governments respond. People in government, legislators respond to people that give them money, not what's best for the average person. The article says the following: the government has today announced the results of the 5th auction of contracts for difference subsidies for renewable electricity generation. It has been a failure and may represent a landmark moment for renewables policy. Only 3.7 gigawatts of new capacity has bid successfully, mostly through small projects, as compared to nearly 12 gigawatts last year. There were no bids for offshore wind, the UK's flagship renewable generator. While offshore wind's failure to bid may be surprising to some, perhaps even to the government, it will come as no shock to those familiar with the long-term capital and operating cost trends for wind power. As revealed in audited financial statements, costs have not been falling dramatically as the industry claimed. All around the world, the wind industry is in trouble for the same reasons. Costs remain high, and high levels of subsidy are needed to reward investors. There you go. Warren Buffett, arguably one of the best, if not best, investors of all time, was asked this question many years ago. I've repeated this. When he bought Mid-America Energy, went on this big wind building thing, and he was asked about this. And he said, if we didn't get the subsidies, we wouldn't build them. They're not economically viable without the subsidies. And so even with the current subsidies, it doesn't work. And so expect them to come back and ask for more money from the government, because they're not going to give up the dream until you go in there, pick them up by the nape of their neck, and literally throw them out. You're not going to put Keir Starmer in there and he's going to all of a sudden realize that this doesn't work. They're just going to double down. Tories or the Labor, it doesn't matter. Same thing here in the US. Democrats or Republicans. The lobby is too big. There's too many hundreds of billions of dollars now. Okay, this isn't 1982 when they had a few guys in a garage making these things by hand. This is a big deal now. And so I expect that, they're not going to give up without a fight. They're going to come back and ask for more subsidies because we got to do the transition. Don't you understand? The earth is at risk. The children, grandma, you know the story. So, doesn't work. It's bottom line. Another reason why I remain long-term bullish on nuclear power. As you can see, some people are getting wise and shifting their view to that. Here's an article about the UK. Basically, British people put climate on ice as living costs soar. More than half of British people are too preoccupied with the rising cost of living to prioritize climate change concerns, according to a survey. The survey, which involved 1,000 respondents, highlighted that almost 51% of respondents expressed a desire to contribute more towards environmental efforts, but cited financial constraints as a significant obstacle. They've had survey after survey after survey. Of course, everybody, if you structure the question, is for climate change concerns, depending on how you structure it, because the people are brainwashed and actually don't understand terms properly or what they're even being asked. If you ask them to pay for it, they're survey after survey, time after time, they've been unwilling to do that. It's just that simple. And especially now, with people are struggling economically, there's no appetite for this. Okay, people just want their costs to go down. So we'll see how it ends up. Again, I can't predict the future, but with certainty. But I would suggest that until you go in there and throw all these bums out and get like people in there that actually, look at reality and math, which I doubt will happen either, then you're going to continue to have this nonsense. So again, this is just more of the ESG, peak ESG. ESG is dead. I just thought this was interesting. It says Barclays taps Betty Jiang to lead oil and gas E&P equity research. Okay, so what? That's what you're asking. Like, what's that mean? Well, read further on. Barclays has hired Betty Jiang to cover the large. I don't know who Betty Jiang is. I don't know anything about this person, but the punchline's coming up. Barclays has hired Betty Jiang to cover the largest U.S. oil and exploration and production stocks. Well, that's interesting because I thought we were phasing those out. According to a person familiar with the matter, Jiang joins Barclays as managing director, senior equity analyst of U.S. integrated oils and exploration and production companies. She was previously at Credit Suisse, where she was head of ESG research in the U.S. It's always about the money, folks. Show me the incentive, and I'll tell you the outcome. The bottom line, unfortunately, is always the bottom line. So that's where the money is. They asked Willie Sutcliffe, the bank robber, why did he, I think that was his name, why did he rob banks? Because that's where the money is. So there you have it. I think that's the last slide for this week. Here's the last one I wanted to show you. So we talked about vitamin D levels, okay, and how they're so beneficial, especially around flu and cold season, and so many other things too. It's almost like a wonder substance. I'm hesitant to say that because it sounds quackish, but there is sufficient research that shows that you're more susceptible to disease if you have a lower vitamin D level. It's just so instrumental in so many mechanisms in your body around immune health. And so here's a vitamin D blood serum levels, basically nanograms per milliliter on the bottom. And here's your COVID death rate on the vertical, right? It's obvious. The lower your vitamin D levels are, the more susceptible you are to dying of COVID, if you're concerned about that. But it's not just COVID, it's a lot of other cancer, everything else. And so it's incumbent upon you to get your blood serum levels up to this 50 nanogram per milliliter. I'm not a doctor, consult with a doctor or whoever on this, but do your own research again. You can do this by taking your shirt off for 10 minutes a day and absorbing sunlight. The body in its God-given created state, has the ability to create D3 via sunlight. You absorb the sunlight, your body creates the D3 or the vitamin D. If you're unable to do that, or if you're worried about skin cancer or whatever, I don't think that's much of a concern for 10 or 15 minutes a day, but you might not be able to do that, especially if you're in a northern climate in the winter. Then you should look to supplement. And it takes time to build it up. It could take 30 days to get it up. If you're at these low levels, to get it up to the 40 to 50 level. And so you can do some research and see what the recommended dosages are to get your vitamin D level up. I would suggest when you go to the doctor next time for your checkup that you have your vitamin D level checked. You'll have to pay additional money because it's not part of the standard test battery. It should be, because of the preventiveness, but we don't have a healthcare industry, we have a sick care industry. That's a whole nother dialogue I don't want to get into. But this is one of the easiest things you can do to improve your health overall, is get your vitamin D level up and maintain it. So I think this is important. And just walking, try to get your steps in every day. If you just do those two things, and don't eat a lot of processed food, you'll be doing more than 98% of the people do, and you'll probably have a better outcome. I mean, genetics obviously has a part in this, but this is simple things that anyone can do. All right, I think that's it for this week. Yes, it is. Thank you for participating, watching the videos. I know a lot of people are interested in uranium. Whenever I mention uranium in the titles, we get a lot of interaction. If you're interested, if you're a new viewer and you're interested to understand how we put the ideas and topics discussed in these weekly videos into practice in investing and speculating, you can take a subscription to the Actionable Intelligence Alert newsletter. The link is in the show notes, and that will be a tool that will give you some ideas about how we are, at least the subscribers and myself, how we are taking advantage in the financial markets of these trends. So that's it for this week. Thank you guys, and we'll talk to you next week.